We'll talk about what is franchising. We'll talk about why companies do franchising. We'll talk about franchising in India and globally, types of franchising and their profiles, expansion models in franchising, key characteristics and attributes of franchising. We'll also talk about the documentation which is required, as I said, building your capabilities. And I will take the Picasso theory in the next piece. So I think by this stage, we'll do that. Picasso theory is something which I built a few years back. And I strongly believe if you want to make it a sustainable business model, you should really build on the Picasso theory. Picasso was actually an artist. I use his name to define that theory. So that's for the next. So we'll cover the first 7 points in today's presentation, and then the next presentation, which is the sustainability, we'll get on to a few more topics which needs to be done. So franchising is a replication of a proven business system and granting the rights to run and operate a business under the brand name in return of a fee. That's what in a little fee, meaning it's a right of privilege granted. When you give somebody rights of your brand and your know-how to somebody else to run and operate a commercial business under that, against that they give you a franchise fees or a royalty, or you make margins in the supply chain. That becomes a franchising. So it is the greatest marketing idea ever. Why I say this? Because if you really see, franchising is a great marketing idea. Once you have a successful business model and you go out and duplicate in different markets, you build a huge amount of brand equity. I'll start with giving you an example of a company called Subway. They have only one company-owned outlet and 46,000 outlets globally. Now you can see it is a household name. Everybody knows about it. But have you seen a great marketing coming out? They don't have to, because their outlet duplicated has actually created a phenomenal amount of marketing for them and a large consumer base in the world. It's the biggest sandwich maker in the world. And to me, it's the greatest idea. It was a simple idea, very, very basic, simple idea. And because it made money for people, it started duplicating and creating. Impacts all industries. A lot of people come to me and say franchising is limited to few industries. Answer is no. Franchising really goes into across industries. I'll give you an example from manufacturing businesses, from like a bottling company like a Coca-Cola or a Pepsi can be a franchise model, to a logistic company like a DTDC or a DHL or a FedEx can be a franchise, to from your retail and businesses to your service businesses, across category, across the consumption line. Anything you consume really comes from a franchise. So almost all industries are impacted. Contributes about $4 trillion in world economy, and India, it's about $35 billion. So what is franchising? Franchising, when I had to define this, I would define into 4 different parts, which are the key pillars of franchising. One, it is about people, which put trust and respect and finally individuality. I'll explain you a little more. Every business is individually handled, individually run. So it respects individuality. It has a huge respect for the brand. We put trust on the contract we sign, and it's all about people. So relationship in the franchising has to be interdependent. If you see the blocks, the quadrant downstairs, these are the elements of franchising which are very, very important. The relationship has to be interdependent. When you design your franchise model, it has to be very clearly an interdependent model. Both franchisor is somebody who gives rights of the business, and the franchisee. Franchisee is somebody who takes the rights. Both have responsibility. It's not that it's one-sided responsibility. Both have responsibility. They need to also put a system which encourages success. It's a collective system. It is not that the franchisor is ready with the system alone. It is the collective system which creates success. A system should also solve problems. All major ideas in evolved franchise businesses, even if you really see, the 60% of a McDonald's menu really came from the ideas of their franchisees. And when they went into the market, they saw the feedback, and that feedback was really adopted in that. And every time they evolved from one situation to another situation, and all these situations really came from the feedbacks of their franchisees. So systems should encourage problem-solving methods, and systems should manage relationship. It's all about relationship. Fundamental to franchising is not a employee or employee relationship. Employer or employee relationship. It is not a principal or agent relationship. It is one managing director managing another managing director. It's an owner and owner relationship. So if you understand psychologically, it is an owner to owner relationship. That's how the business really drives it. Both have different obligation, different kind of responsibility, but fundamentally it is one owner talking to another owner. That's the kind of a relationship it is. Why do companies franchise? This is very, very important aspect. Companies franchise because it's a modern way to raise capital. So when you want to get into franchising, and most importantly, especially I see the early stage companies, why they get into franchising, because that's the best way to get raise money. What are the other alternatives for companies to raise money? Either they have to take a debt to grow their business, or they take equity. Both are very, very difficult. It's very difficult to get that. So it's a great way of raising capital. It also helps you to expand faster, rapid penetration pan India. It is also very, very effective to handle operational challenges, especially in these times when there is a huge amount of complexity, difficult of travel going on, and everything else around us. It is a great strategy to handle your operational challenges. It also is a great way to build your brand equity. Building your brand equity is quick and convenient. The great example I'll give you, one of the success stories of Franchiseindia has been a company called Ferns and Petals, which is a flower shop company. Simple business model, actually very complex business model. From everything in the supply chain, you cannot do the supply chain centrally because it's only 6 hours the flowers would last. It's most perishable product. Now you cannot handle supply chain, you cannot centralize, do purchasing. Everything has to be done locally. Because the brand expanded all markets and it became a really answer or a generic in when people think about flowers, because of the brand equity, now franchises are collectively working under that. But if you really see, this was so simple a business that anybody can run a flower shop. You have to still go to a local mandi to procure flowers and sell it out of the shop. The only thing which is common between all of these is actually brand, which now controls the customer. So brand building is a very important aspect of it. It also really helps you to grow your market reputation, and it is also can be damaging if you don't do well in franchising. It can really pull down your market reputation, and there are also some examples of that. There are big failures which happened in franchising. It happened with large corporates also. Even Reliance at one time had to pass through that with their 2 formats, which had to struggle in the initial days. One, the web world, they opened up a large format, 10-15,000 square feet of their web world, and also had challenges in their petrol pump business because of the regulator, and subsidy was not available to private operators. So they were selling at higher diesel cost, and so they were not able to sustain with the public sector companies. So sometimes even the large companies which have very strong business design can have issues on their market reputation going down because of the failed franchise system done that. One of the biggest failures was a company called Eskumar. Eskumar ran a very big franchise program. I don't know how many people would know that, but in 90s they ran a very big program, and even early 2000 they ran a big program, and that entire program really collapsed. All their franchises were shut. So there were big issues with their market reputation at that time. Another thing which is very, very important, that independent businesses would not be able to survive. I've been saying this for last 20 years. I find that independent businesses would find it extremely difficult to survive. Either they have to close down or they have to merge with something because of input cost and your economy scale. Economy scale is very, very important for businesses now. If you want to really compete with the big boys like Amazon and likes of them, you need to have a large purchasing capability. I'll give you an example. If you run a consumer electronics store, which we used to have, multi-brand still runs in smaller cities, especially if you go on a tier 2 or tier 3 or tier 4 cities, you'll find this multi-brand consumer electronics store. The typical margin they would have from the brands which they would work, which is Samsung, LG, other companies, is ranging from 12 to 13%. That's what the margin they would be running at. But when it comes to organized player like a Chroma, which is also a Franchiseindia's client now, and also a big modern retail player, and franchising now, they would have a margin upward of 20%. Plus, they would have a marketing spend, committed marketing spend by all these brands on a store-to-store basis, which means that they would get a certain amount of fee from every single brand per store basis to promote their brand and do this and that thing. But you already see what is the margin play, what they have. And if you go to a player like an Amazon or a Flipkart, this can go to 24-25% in certain cases and certain categories. So you really see how would this independent retailer ever be able to compete with this and that thing. This margin is on continue to rise, and this would continue to rise as economies of scale would entirely. So even a small Kriana would not be able to sustain in times to come. They have to either convert, and that's why the new franchising is started conversion franchise, where a lot of these bigger companies like Jio is converting these independent Kirana stores just because they now have this economy of scale play. A typical Kirana is struggling between 13, 14, 15% kind of a margin. So which means that he has to put everything to get that kind of thing. And for a Reliance or a Jio, they would run at a 17, 18, 19% play. And then their private label strategy would give them even more margin, and then the other categories would come in. So eventually they would be able to push their margins up to about 20 odd percent. And in FMCG, 5-6% play becomes a huge play. Even if they go out and give the Kirana single window service and say, you don't have to go to 30, 50, 100 different distributors, you just buy from us and we'll still give you a maybe a 2% extra. So the Kiryanas would have obviously a great idea to convert with you, and that's already has started. So you see this whole conversion of unorganized part to organized would start, and franchising would play a very important role. We call the conversion franchise, and a lot of companies I'm encouraging, if they are already ahead of that and they already have a some kind of a business advantage sitting with them, they should really look at this conversion franchise model. And I personally feel that next 5 to 10 years a lot of conversion would happen to these independent run businesses. It can be retail businesses, it can be service businesses. They have to convert because they will not be able to do economy of scale both in their input cost and their marketing cost. Marketing cost also would become very difficult for the independent retailers or independent service providers to manage. So 3 very important areas why companies franchise. One is time and speed. Because of expansion and speed, if you want to really rapidly grow, franchising is a great strategy. There is no way you can grow to 46,000 restaurants like Subway has done with your company-owned operations. So if you really see, almost all successful companies globally have chosen franchising, especially large companies, not for the later two, not for the capital and human resource, but they've actually done it for time and speed because that's what would work very well for them. The second reason is obviously capital, and third is locked in human resource. That's also very important, especially for service kind of businesses. Service businesses need somebody who is involved in the business and they are able to really look after the businesses. And Europe particularly, I see even largest of the corporations are using this called operator franchisee because they feel that the locked in talent is very, very important for businesses. And I also feel in India, that's very important aspect of business. We created a model for a pathology company called Dr. Lal and created these collection points. And the idea was not really to put, this was not a capital issue. It was about getting a strong operator who would be available, who would demand service whenever the patient is required. He will be always on the entire piece. Rather like company-owned operations, franchisee operations are much more efficient and much more involved. So a lot of companies are now looking at an operator because they feel that there is a locked-in human resource, which is a big sport. Like these days, almost all company-owned businesses are struggling because it's not motivating enough for bringing the talent to come back to job. If say you are paying somebody 15,000 rupees to bring him to work every single day when all this health issues and other things are happening, is very, very difficult. But if somebody is invested into the business, is invested his own 20 lakhs, 30 lakhs into business, he will make sure that he comes for the business because he's invested much deeper into that. Otherwise, a lot of people would not be encouraged to come to jobs. So it's becoming in these times even more important that you bring in a strong operator for your business. So a lot of trends which are supporting franchising, obviously in demand side, increasing consumption, growing preference on branded products, global exposure has helped because everybody is now internet connected, everybody sees what is available in the world, and people are willing to spend. While I think the consumption would have some kind of debt because of this COVID part of the business. But I am more excited about franchising for the second part of it, which is our supply side. The bigger opportunity is the demand side from entrepreneurs in this country, because in country like India, we don't create white collar jobs beyond 5 or 6 cities. 5, 6 cities, we create a white collar job. Today, franchising is fortunate that we run our operations in over 100 cities. And if I go and see the cities, yesterday I was making a sheet for 100 top performing cities, and I looked at the cities. Out of the 6 or 7 cities, I didn't find any single city which would have potential to create great white collar jobs, which means that you cannot even create a job for 50, 60, 70,000 rupees in these cities. Do the cities have potential? Absolutely great potential. a lot of good entrepreneurs, people who have willingness to start something for themselves, and that's something which is exciting for us. Like last 3 months, we opened up 9 different franchises for Haldiram, East Haldiram in Bihar. Now, cities which we have really finalized these, and I don't think there is any kind of a job opportunity or any other career opportunity, but there are people who are sitting on capital and they are looking to start something for themselves. So there is a huge amount of opportunity in this, especially in the tier 2, tier 3, tier 4 cities, where people have aspiration to start something with that demand. To me, is a very, very large demand, and that was exciting for franchising growth. Even if you look at real franchise growth in US, which is a top market in the world, you see that growth really didn't come from a New York and San Francisco and Washington DC or a Chicago. The really opportunities came from smaller cities where people had to do something and they chose to start their own franchise. And rather, I think franchising can be a huge contributor today, because it will further create employment. If somebody starts a franchisee, hires 3, 4, 5 people to start the unit, it creates 5 more jobs. And I feel that franchising can be a great sport to Indian economy. If we are able to do this franchising all over all markets, and especially smaller markets, we'll also help creating a large amount of jobs. And that's something which I've been actually talking to MSME ministry and other ministries to start recognizing franchising, because it can be a great job creator, especially for India, where 75% or over is non-manufacturing businesses, which are retail and service, where franchising has the maximum impact. In the 75% of that businesses would be retail and service businesses or trading businesses, where franchising would have a very, very strong impact. Fortunately, we had opportunity to work all 3 of them: McDonald's, Subway, and 7-Eleven. Subway was my first company I started representing in 1999. I signed a contract with Subway to represent for India in 1999, actually April 1st. That was the day I really signed with them. But between Francorp and Franchiseindia, we had an opportunity to work with all 3 companies, and 7-Eleven was a company Francorp actually took international. They were never international. Now, a large part of the company is owned by Japanese, and actually Francorp was a company which took 7-Eleven from US to Japan in early 80s. And Don Borian, who's the chairman of Francorp, actually handled the entire assignment himself. So this is important. This is for people who are new to franchising. They need to understand types of different franchisees. The first type, which we very commonly use, is called the single unit franchise. Typically, you take a unit. It can be sometimes having some exclusivity. Exclusivity would mean the 3-5 kilometer radius, depending on the business model. And sometimes you will not have an exclusivity because businesses like service businesses have overlap. So you will not be able to give exclusivity, but you will recognize a location, and the location would be a single unit franchise. This is the most popular way of doing it. Second, which is also becoming very, very popular, and I have actually done this franchising a lot of times, is called multi-unit franchise. The first company I really introduced multi-unit franchise was a company called Levi's. Levi's in 2007, we worked with them and created a multi-unit franchise model, because when we used to franchise Levi's, everybody wanted in that city a particular location. Like Delhi, everybody wants Southex, because Southex was that market where retail was very popular, but you have only one Southex. But Levi's wants to be in Faridabad also. Faridabad wants to be in Noida also. They want in other places also. So we used to create a bundle of 5 locations, and every single franchisee has to take a location of that. Actually, the now largest Planet Sport is a separate company, which is the largest multi-unit franchisee for Levi's. And Levi's actually started from India, these exclusive stores. A lot of people think that Levi's, being a global company, would be doing franchising. Actually, no. Franchising in US, they started only 10 years back. Because of their success of Asia, and especially India, was one of the big success stories for Levi's. Levi's in America was actually a multi-brand store, which means that they were in Walmarts and they were in the large big box stores, Macy's and other places, and they were not having independent stores. And when we started in India, they learnings from India or other places, they learned, and they started putting those stores in US also. Now US also, they are actively franchising as an independent, which we call the EBOs, the independent exclusive stores of. Then there is a master franchise. Master franchise is normally used from a country to country franchise. Master franchisee is that where a master would duplicate the complete role of the company in that particular region, from building local capabilities, sub-franchising their business, and also supporting their franchisee. Another model which have been very usefully used by Franchiseindia is area development franchising. It's not so much a master. You don't really participate in customization of the product and services. Largely, you are responsible for developing the area. I normally would recommend companies using area franchise, more, because it gives you much deeper capabilities in particular market, and you have somebody who would constantly work on getting new franchisees on board, finding the right location, and giving a day-to-day supply chain support to your franchisees, and you will be able to do a much deeper penetration for that. One of the companies which have actually used it very successfully globally is Subway. Subway is one of the fastest growing franchise systems in the world, and they have used the area developer model. So they don't give exclusive rights of India. So like in India, there are about 30 different area developers, and each area has a responsibility to develop their area. There's not even a single master. Now, even international companies, when they come to us, I normally would not recommend them to do a single master, because it's like putting all your eggs in one basket, and sometimes if they don't perform, they are not able to really do well in that sense. So normally we like to break that. The first time Sabaro entered India, they gave one master and had huge challenges. Rather, we worked with them to change that master, and then I created an area franchise strategy, and today they have multiple area franchises, about 3 or different area franchises, and one of them actually is a lady which I franchised in Bombay, and she is very successfully doing that. And she was actually a franchisee of Subway, and I handpicked her and gave her the franchise, area franchise, because she was very operator, hands-on, understood the business, and committed herself to really start. Then there's also different other models, which are conversion franchise. I personally feel that it's a great strategy. Today, if you are able to go and convert, I've been a strong believer that it's not about modern retail, it's about modernizing retail, which means that we have more shops than any part of the world. To every 80 Indians, there is one shop. To 150 Americans, there is one shop. So we don't need more shops. We don't need more service points. We don't need a point of sales. What we need to do is modernizing them. And Franchiseindia today is working with a lot of clients on working on converting these businesses. I feel that independent pharmacies would have to convert to a branded pharmacies. Independent Kiryanas would have to convert into this. Independent multi-brand stores have to do that. Independent multi-brand fashion stores would have to convert into something. So there is a lot of conversion opportunity which is available in the country. Then there is a job franchising, which is actually where investment is technically done by the company, and they need somebody to run and operate. And the third part is turnkey franchisee, where you build, operate, and transfer to franchisee. A lot of companies actually take the full responsibility to do that, and then they transfer it to somebody else. Big difference in how you approach franchising. When you are looking at a product-based franchising, the margins are normally built in the product, and then you would transfer the at a wholesale price, transfer the product to your franchisee, and you will make margin in the supply chain. Typically, like an apparel, footwear, FMCG kind of companies, normally they would have very little franchise fees just to cover the cost of acquisition, and normally there would be no royalties. Sometimes companies would build in some kind of a advertisement levy, a common advertising fund, maybe a 0.5% or a 1% kind of thing, but normally there would be no royalties in the business. This is a mistake. A lot of companies, when they product-based start, they start thinking about charging royalties also. It has no meaning to me. Why are you charging royalties? Because you're supplying all the product. So it's a very it has no meaning to me, the charging of royalties. But when you come to a service kind of a businesses, where the service is actually locally rendered, and there normally you will have a higher franchise fees and also royalties, and royalties can differ from different businesses. It can be as low as 2.5% and can go as high as 15-20%, depending on, say, if you are in a business of education, coaching kind of a businesses, the royalties can be as high as 15%. So it can be as low as 2-3% in certain categories where your margin of service is very, very low. Food, which is very popular, the royalties can range from 6 to 8%. In dark kitchens, I'm normally recommending much lower royalties because you have a big pressure on paying to these platforms. So I'm encouraging 3 to 4% of royalties. Sometimes companies design it wrong, and they are not able to find the franchisee able to sustain, and that's where the first dispute happens. So very clearly, very important is to really think through before you start making your franchise model, because sometimes if you place the wrong royalties and franchise fees, it would be not sustainable for a franchisee. So these are three types of profiles of franchisees we would get. We will get some enthusiast people, first-time business buyers, over expecting from themselves. You need to align their expectation. They are some most of them would have over expectation from businesses, have high expectation, high ROI expectation. Then I like the most, which are the realistic ones, which I call the mid segment of investors, which is I call the low middle risk and reward kind of a profile. And then you have very accomplished, seasoned entrepreneurs who are very realistic on their expectation on that. The best are the middle ones. That's what is the best performing franchisees. I feel that if you get too excited, somebody who's overconfident about what they want to achieve creates a lot of disappointment. And that's what we see. A lot of first time franchise buyers actually get disappointed because what they expected out of the franchise to pay didn't do that. And these accomplished, the seasons one, are normally looking for long-term opportunities. They would look at a healthcare or a hospital investment or a school investment or things of that nature. Their expectation is very very realistic on the capital they deploy. Typically, if I have to really put from an expectation viewpoint, the topmost would have an expectation of anything upward of 30% return on capital. The middle ones are normally at a 20 plus percent, and the lower ones are 15+% kind of an expectation. So really think through your business model and understand who you need. And this is one of the areas which we work very closely with our clients to define the right target group of the potential franchisees you want from your business. So these are terms which normally are used in the market, where we call it a franchise owned, franchise operated, where both the investment is done by the franchisee and franchisee runs that business also. This is independently owned, independently operated. The most popular and the right model for franchising. Then we have a model called FOCO, which is franchisee owned, company operated. Now that FOCO is where a franchisee owns that, but he doesn't run that business. This is normally done in businesses which needs larger capability of management, which the company would not see available with the franchisee. It's normally done in hotels, hospitals, kind of a structure, like the GVK, which is a group out of Hyderabad, is one of the largest franchisees from Taj Hotels, which is Indian hotels. So they would run two Taj properties in Hyderabad. They have a property in Chandigarh. They have a property in Chennai. They have a property now in Bombay. So all these are owned by GVK and run by Taj. Some have also this model called COFO, which is company owned and franchisee operated. Now, this is a very rare case, only in cases where companies feel that they need to have a strong local operator to run and manage it. More importantly, either it has to be somebody strategic or somebody who can bring in the last mile efficiencies. One of the companies that successfully used is Bata. Bata used to take all the investment, and the franchisee was the store manager, who used to be made a franchisee with this small investment of 10 odd lakh rupees, just a commitment fee, and rest all the investment was done by Bata. And this was a COFO model used for them. They actually converted their FOFO to a COFO because they felt that the involvement of somebody who's like an owner would play a very important role to ensure profitability store by store. And then build, operate, transfer. This is something which we are doing considerably now, because and I'm using this strategy for a lot of companies who are suffering with liquidity and cash flows. A lot of brand owners who run their company owned business come to us, and they are at this stage cash tight. Everybody is cash tight because you have eaten last 14 months your reserves, and cash flows are not coming to the same level. So how do companies create liquidity? So this is one of the areas which we are working very closely with companies to convert their existing stores into a franchise. Like Chroma, we are doing that. Biba, we are doing that. A lot of companies which are coming to us and saying, I can give my running profitable store to a potential franchisee if they really need to do that. So some of the areas which we really have to see into any potential franchisee, his eagerness to work, his willingness to work, eagerness to learn, putting long hours, people skills, sales abilities, ability to take direction. This is one of the areas which is a big problem with sometimes franchisees. They are not somebody who wants to take instructions, but the good part with franchising is that there is only one system which plays in. And I've seen a lot of franchisees want to do their own way of running the business. They are not the best to be selected. So always avoid franchisees like that who have their own way to do that. While they can enhance what is going on from the current system, but if they want to reinvent the whole business model or want to perceive a different perspective on that, they can actually kill the business. And a lot of early stage franchise companies actually get into the trap. So they would have investors coming and tell about their ideas because you look like selling a franchise, you agree on that, and that's a mistake. That's a mistake because sometimes they have a different expectation altogether, and that should not be encouraged by any franchise company. You should really be sure what you want, and even somebody wants to give you, like sometimes investor will come and say, you need only 1,000 square feet, but I have 5,000. I want to make a big store. It might sound like at that time it is a great because you will have this signature store coming in, but eventually he's going to complain you for why he invested into that 5,000. So stay very sure. Even if you are a very early stage company, become very clear that you don't want them to change any form your business model. If you try to change the business model, it'll always become confused and you will not go anywhere. Look at the business skills they have, very important. One of the companies which we started working early days was a company called Eurokids. Eurokids, great organization, now the largest preschool company. But when we started working with them, we created a model which was a woman entrepreneur model, and we got this very well accepted in the market. A lot of women really started, and then we started recognizing a big problem that all of these women who took that were actually not working and didn't have a kind of active career lives going on. They were mostly contributing in home, and they took the franchise because the investment came from their husbands or anybody else. And we found that they lacked even basic skills, basic accounting skills, basic other management skills, basic marketing skills. So we really had to train them on how to run and operate a business. Before we can even train them how to run a preschool, we actually had to train them on running a basic business. So that's also an area which needs to be done. Another thing which is very important is to see how much reserve capital a franchisee would need to do and how willing he is to take risk. Age is also a very big factor when you select a franchisee. Depending on what kind of business you're looking at, you need to really see what age group would make more sense. So these are 12-point checklist. When a company comes to us and say, we want to get into franchising, we say, go out and check these 12 points. And if you have these 12 points being tick marked, and some you will be ready and some you will not, then you are ready for franchising. And scale yourself on 1 to 5. Check your credibility. See if you have refined and successful prototype business. Earlier days, Franchiseindia had a lot of companies came to us at an ideation stage. They have an idea and they want to really franchise. And we felt idea was great, it had merit, and we started helping them in franchising, and a lot of them were not successful because they had no prototype. They've really not done that. They've not even gone and executed that. So absolutely no at this stage for a Franchiseindia and FranCop. We only want to work with companies who have refined and successful prototype available in the market. If you don't have a prototype, go and fix that prototype. We can work with you to get the prototype right, but we will not start franchising your business unless until your refined and prototype is there. Also see your market trends and conditions. If the market trend is favoring your business or industry. Fourth is, what is the differentiation you are creating in? What kind of differentiation you're bringing for your business model? Fifth is documentation, how well your systems and processes are documented. Sixth is capital. What kind of capital? Why franchising works on other people capital, other people money, but you still need to have enough capital to support your network to do that. This is another 7th point, is very important. A lot of entrepreneurs we meet are very good. They know how to run their own business, but they have no ability to transfer that knowledge to somebody else. Actually, companies which have ability to transfer the knowledge, and that's where I keep going back to a company called Subway, because Subway was designed to be idiot proof. You can transfer a knowledge to somebody else, and he or she can make in 2 days, understand how to run a business, can make the best sandwiches possible. So it was so easy to transfer that business model. Sometimes businesses are not transferable. I spent a considerable time in a company called Haldiram in Nagpur, and I went there, saw their operations. We had multiple debates, and I realized that the way the business was designed, in a single outlet of Haldiram, there were over 300 people, different kind of skill sets. Somebody who's good at making only Bengali sweets, somebody is making something else, somebody is making something. So it was so many skills which were really built in. It was so complex for a franchisee to transfer. It was not the opportunity. Company was able to see the opportunity. Wherever they open up, they will do very well. But how do they really franchise that business? Now they started franchising, but they're only doing the packed food business. And it makes sense because they would not be able to transfer that same kind of a knowledge base, because it was not very assembly line business. Versus when you go to McDonald's, it's a very assembly line business. It's all very systematic, and systems can really look after the business. Even an 18-year-old can deliver their product. So how do you really make your business model ready to be transferred to somebody else is very important. How do you design your affordability of a business model? Affordability is also very important, depending on the industry you are in. Like, for example, a company we did called Castrol Bike Zone. Big company. Castrol is a great organization, and they created a two-wheeler service model just to change oil. And the whole model, because it was Castrol, they hired the biggest architects, consultants, and they created a model which was 35 lakhs. And my question was that if I have 35 lakh rupees, do you think I will open up a oil change garage for two-wheelers? It doesn't reflect. Somebody who really wanted would not have that affordability, right? And it had many debate, and they said, no, we want to do this. And they opened up that, and this was not able to do that, and the entire network collapsed because it was a wrong set. If they would have done and found real hardcore operators, elevated even the mechanics which were there in the market, but they cannot spend 35 lakh rupees. They can maybe spend 4-5 lakh rupees. And actually that was the only thing required in the business model, which was simple. And this would have been successful. Like now Mahindra has a two-wheeler model of service. This comes at the same price points, much cheaper than that. But Castrol was the first company to really start this business model because they felt that that was a segment they want to really engage. Commitment to relationships is very important. How committed you are to your relationship. Adaptability of your business model in different markets, again a very big important aspect. Some businesses find it very difficult to survive in any market which is beyond the entire. Like for example, there's a brand called Jumbo Vada Pav now it's called Jumbo King in Bombay, and great brand, great operator. But whenever it came from outside Bombay to any other market, while it was still a product which everybody can appreciate, but it failed because Vada Pav by nature means value product. It has to be a low pricing. When it is a low pricing product, it needs a phenomenal amount of volume. Now, if you want to do that kind of volume, the only place you will get is Bombay. If you, especially outside the railway station or a local station, you have that kind of a footfall where you can churn 1,000 Vada Pavs, 2,000 Vada Pavs. But which other market in India would have that ability to have 1,000 people or 2,000 people coming in? None. So even the product which looks like the Indian burger story would fail in all the other markets, because if I opened up in Gurgaon, which they did, where would I get these 1,000 people coming from, right? And acceptability of the product and the kind of a profiling, it would not work. So sometimes brands find it difficult to go to new markets because they would not have that kind of acceptability. Return on investments, also very important aspect, and strength of management, how your management is designed, because people today invest on founders. They don't invest on businesses and concepts. This has big change happened. People are actually investing in people rather than investing in businesses. And that's becoming more and more important. That's why if you really see companies like Tesla, if you see Elon Musk and people like them have become individually very popular. People actually are seeing them. While they are a large organization, they are big corporates and they have large kind of capabilities, but people really still see what Elon Musk is saying, what he wants to believe in, what his structure is. So this is historically changed. Now people really want to look at the founder and the management team to invest on versus, so to say, the company itself, because that's a big change. And in late 90s or 80s, this was all different. Everything was really about these large corporates to be invested on. It was not about the founder or the people behind it. And this is one of the areas which even Rahul Bajaj recently commented, that earlier brands used to make people, now people are making brands. So this has changed in the way people look at opportunities now. So this is very important when you're designing your organizational and making your organization ready for franchising. You need to divide that into 4 baskets. First is opportunity assessment. Understand how big is an opportunity for your business like that. And in India, this is a shift market. You're shifting the customer from something which they are consuming already, and they're shifting to you. So you need to really define that. And this is one complex part of it. How do you really define the opportunity? How big is an opportunity? Then what is your value proposition? What value proposition you want to give it to your consumer? Third is what kind of organizational capability you need to build to manage and deliver the value proposition. And on that, you make a rollout. So I always would say, start from the capability. Start the capability, what kind of capability you need to deliver the value proposition to capture the opportunity. That's the sequence. So we work with clients to go deeper into understanding their organizational capability, to define their value proposition very clearly, and then to go out and capture the opportunity. So I'll quickly run through this documentation. These are 6 odd pillars which are very important when you are thinking about developing your franchise network. First, develop your strategy. You need to have a very definite and a strong strategy in place. Never compromise that. Give a deep thinking. And this is a great time. If you're really thinking to get into franchise, and a lot of people are coming and say, is it a good time to get into franchising? I will say, absolutely. If you even think about starting your first franchisee to be operational in January, February next year, you need to start thinking now. So why? Because even if you start now, it will take you at least 90 days to prepare yourself as a franchise ready. So which means that you're a June, July, August goes into that. When you got August, then you start franchise sales and marketing for that, which means that September, October, you start marketing yourself. Even if you are in November, December, signs the first franchisee, by the time franchisee is ready to open up the location or start doing it, it will be January, February, March. So which means that if you have looking at a franchisee to come in your business for the first quarter or the last quarter of this financial year or first quarter of calendar year, you need to start now, right? So a lot of times people have this wrong reference point and say, is it a good time to franchise? I would say it's not. If you feel that the 2022 is a year which you want to do franchising, then this probably would be the best time for you to really start working on that. So work on your strategy, work on your detailed financial number, work on a good legal documentation, work on your operating manuals, training manuals, work on your marketing collaterals, communication, videos, everything, how you can create a wow for a franchisee or a potential franchisee to look at it, and work on a very strong training capability, how a person can run and operate your business. Everything has to be documented and everything has to be trained. This is one of the areas which has a very big weak point in companies. So I'll quickly go through this part and what all we need to cover in this. So strategy would be your financial feasibility, your market competition assessment, understand the life of a business model, and create your control mechanism. 4 strong pillars which you need to really work on. And this would also mean understanding your competition in depth. And competition cannot be just apple to apple. It can be apple to orange. You need to really see, if I have 30 lakh rupees, why should I invest in your business versus any other opportunity available for 30 lakhs? It can be even a passive opportunity, which is much safer for a person to invest. So when you do financial model, you need to go into very high detail on unit level economics of the business model. You need to also do your micro level economics. You need to understand your cost of acquisition. You need to understand your support and vendor cost. You need to also understand your logistic delivery cost, every important aspect to create your unit level economics. And also for franchisors, I would say they need to create a phase wise financial model for them. If they are in the first phase of their expansion, what kind of revenues they can really look at from their franchise fees, royalties, other incomes, projects. There are multiple heads in your system which gives you multiple incomes. And for franchisee, also very strongly designed financial model. And you need to give and understand the gestation cycles, especially for a franchisee to understand that. And a lot of times I've seen the franchisers have done a mistake. When they give their financial, they would assume that the peak sales, they would show it from the month one. And it's wrong. It's a wrong design of the business model. No business would start with the same efficiency from the month one. It might be the 12th month, you come down to your optimum capability. It would be only on a second year, you come down to your peak capability. So you need to really define that financial cycle. And it frustrates franchisees because sometimes they don't expect that. They don't expect, they have all the money they put in the business and they don't have further money for next 6 months to sustain. And if a franchisee knows that every month he has to burn some money for next 6 months or 8 months or 1 year before they become cash break even, they start getting frustrated. And that frustration leads to a lot of conflicts. And a lot of times they even close the business in haste. So you need to really define very, very strongly. So I've been actually told that there is a 3-minute to go for a next webinar to start. So I'm much behind my schedule, but we'll cover it from the next series. We'll not leave anything which needs to be done. So in operations, you need to cover your pre-opening manuals, operational manuals, HR manual, and training manual. Legal is a very detailed documentation, never just cut, copy, paste. It needs a lot of strong piece. And I have a special section on this in this 6 series episode. I will touch upon different aspects of a legal piece in a detail. Marketing also, you need to divide your marketing into 3 different types of marketing capability. One is a brand building and development fund. Then your franchise acquisition fund, which should be separate, and your franchise marketing fund, which means helping the franchisee to get more customers. These are 3 different budgets you will create in your marketing plan. What is your brand building and development fund? What is your franchisee acquisition fund? And your franchisee marketing fund. Training also, multiple trainings you need to design for your franchisee. It can be training for the franchisees and their employees. What kind of training cycles you want to do that? Franchiseindia also does 2 forms of training. One is a franchise management workshop and elements of a franchise development, which is a 3-day workshop. So when you are a franchisor, divide that into 4 different departments of your business. One department is your franchise development, which would be accountable for getting new franchises on board. Then you have a project team, which would work on new store opening team called NSO team, which is a new store or a new outlet or new franchisee opening team. They work when you sign the contract with the franchisee. From there, they take over and they work on that. Then you have ops teams, which take over from when the project hands over to operation, they take over the business. And then you have a nucleus, which is your central structure, which is accounts, legal, marketing, HR, becomes your nucleus structure.